Understanding economic bubbles and their collapse. Introduction. Economic bubbles have long been a topic of interest for economists, policymakers, and investors. These bubbles typically involve the rapid inflation of asset prices followed by a sharp collapse, often resulting in significant financial losses and economic downturns. Understanding the underlying causes and consequences of economic bubbles, as well as how they eventually collapse, is crucial for predicting and managing the risks associated with them. This paper explores the dynamics of economic bubbles, examining their formation, stages, collapse, historical examples, and offering insights into strategies for preventing and mitigating their impact on the broader economy. Number 1. What is an economic bubble? An economic bubble refers to a situation in which the price of an asset, such as real estate, stocks, or commodities, rises far beyond its intrinsic value due to speculative demand and irrational investor behavior. The inflated prices eventually become unsustainable, and when the bubble bursts, a sharp decline in asset prices follows, often leading to widespread financial losses and economic disruption. Number 2. The psychology behind economic bubbles. The formation of economic bubbles is deeply rooted in human psychology. Behavioral factors such as herd mentality, greed, and fear of missing out, FOMO, drives investors to make decisions based on emotions rather than rational analysis. As more individuals and institutions join the speculative frenzy, prices continue to rise, exacerbating the bubble. However, as the market becomes overextended, doubt and fear set in, causing the bubble to burst. Number 3. Speculative investment and the role of leverage. Speculative investment is a key driver of economic bubbles. Investors purchase assets not for their inherent value, but with the expectation that they can sell them at higher prices. Leverage, or borrowing money to finance investments, amplifies the demand for assets, which further inflates prices. When asset prices fall, highly leveraged investors face significant losses, and this contributes to the collapse of the bubble. Number 4. The stages of an economic bubble. Economic bubbles typically unfold in several stages. The stealth phase. Asset prices are undervalued and there is little interest or speculation. Awareness phase. Prices start rising, attracting attention from early investors. Mania phase. Prices skyrocket due to speculative demand and investors become euphoric, disregarding the risks. Blow-off phase. The bubble reaches its peak and prices begin to crash rapidly, signaling the collapse of the bubble. Number 5. Causes of economic bubbles. Economic bubbles can be triggered by a combination of factors. Excessive speculation. Speculation investment driven by optimism and greed inflates asset prices beyond their true value. Easy access to credit. Low interest rates and easy credit conditions make it easier for investors to borrow money and increase demand for assets. Irrational exuberance. Investors' overconfidence in the continued success of an asset class can lead to overvaluation and speculation. Regulatory failures. Insufficient oversight of financial markets can allow risky behavior to proliferate, contributing to bubble formation. Number 6. The Dotcom bubble of 2000. The Dotcom bubble of the late 1990s is one of the most notable examples of an economic bubble. Driven by excitement over the internet and technology companies, investors poured money into stocks of dot-com companies, many of which had no profits or even viable business models. When it became clear that many of these companies were unsustainable, the bubble burst, leading to the collapse of numerous technology stocks and a broader market downturn. Number 7. The housing bubble of 2007 and 2008. The housing bubble that led to the global financial crisis of 2007 and 2008 is perhaps the most well-known example of an economic bubble in recent history, fueled by excessive lending, subprime mortgages, and speculation in the real estate market. Housing prices in the United States soared to unsustainable levels. When the housing market collapsed, it triggered a wave of foreclosures, bank failures, and a global recession, demonstrating the devastating impact of an economic bubble collapse. Number 8. The Tulip Mania of the 70th century. Tulip Mania, which occurred in the Netherlands in the 1630s, is often considered the first recorded speculative bubble. Tulip bulbs, which were initially affordable, became highly prized and were traded at inflated prices. At the height of the mania, people were investing vast sums of money in tulip bulbs. When the market crashed, many investors lost their fortunes, and the economic impact was felt across Europe. Number 9. Consequences of economic bubble collapses. The collapse of an economic bubble can lead to severe consequences. Financial losses. Investors, both individual and institutional, suffer substantial losses when asset prices collapse. Economic recession. The collapse of bubbles can trigger broader economic downturns as consumer and business confidence plummets, leading to reduced spending, increased unemployment, and slower economic growth. Social unrest. Widespread financial hardship caused by bubble collapses can lead to social and political unrest as individuals and families experience job losses and financial instability. Number 10. The role of government and regulation. Government intervention and regulation play a significant role in managing economic bubbles. Regulatory bodies can implement measures to monitor and control speculative behavior, promote transparency, and ensure that lending practices are responsible. By enforcing tighter regulations on financial markets, governments can help reduce the likelihood of bubbles forming in the first place. Number 11. The financialization of assets. In many cases, bubbles form in markets where assets have been financialized, meaning they are traded as investment vehicles rather than as products with intrinsic value. For example, the mortgage-backed securities that contributed to the 2008 financial crisis were financialized assets created by packaging individual loans into tradable securities. The rapid growth of financial markets has made it easier for investors to speculate on a wide range of assets, contributing to the formation of bubbles. Number 12. The impact of globalization on economic bubbles. Globalization has made it easier for capital to flow across borders, creating opportunities for investment in international markets. However, this has also increased the risk of economic bubbles spreading across borders. For example, the 2007 and 2008 housing bubble in the US quickly had global repercussions, with financial institutions around the world exposed to the collapse of mortgage-backed securities. Number 13. Managing the risk of economic bubbles. While it is difficult to completely eliminate the possibility of bubbles, there are strategies to manage the risk. Diversification. Investors can reduce risk by diversifying their portfolios across a range of asset classes. Risk assessment. Continuous monitoring of asset prices and economic indicators can help identify the signs of a bubble and allow for early intervention. Prudent lending practices. Financial institutions should adopt responsible lending practices and avoid offering credit to borrowers who are unlikely to repay their loans. Number 14. Learning from past bubble crises. Studying past economic bubbles such as the Dotcom bubble, the housing bubble, and Tulip Mania provides valuable lessons. By understanding the underlying causes of these bubbles and their consequences, policymakers and investors can make more informed decisions. Learning from past mistakes can help prevent future bubbles and mitigate their impact on the economy. Number 15. Preventing future bubbles. Moving forward. The key to preventing future economic bubbles lies in greater transparency, improved regulation, and fostering a more rational investment environment. By encouraging long-term, value-based investing rather than short-term speculation, the risk of asset price inflation can be reduced. Additionally, promoting financial literacy and educating the public about the dangers of speculative bubbles can help reduce the likelihood of mass hysteria and irrational investment behavior. Conclusion. Economic bubbles are an inevitable part of the financial landscape, often arising from speculative investment, irrational exuberance, and psychological factors. However, the impact of a collapse can be devastating, causing financial losses, economic recessions, and social upheaval. By understanding the dynamics of bubbles and learning from past experiences, we can take steps to mitigate the risk of future bubbles and protect the broader economy. Through proper regulation, prudent investment practices, and greater awareness, it is possible to reduce the frequency and severity of economic bubbles, ensuring a more stable and sustainable financial system in the future.